All right, today we're basically becoming data detectives. We're going to take one of the most popular patterns in all of trading, put it right under the microscope, and find out once and for all if it's a real clue or if it's just a wild goose chase.
When you look at the financial markets, it can seem like pure chaos, right? Just a total sea of random noise. But for decades, traders have held this belief that inside all that noise, there are these repeating patterns, little hidden clues that can actually hint at what's coming next. The big question, though, is, are they right? So our main suspect today is a real classic, the bullish engulfing pattern. It's a pretty simple two-candle signal. You've got a bearish candle, maybe from a down day, and it's followed by a bullish candle from an up day. But this bullish candle's body is so big that it completely swallows or engulfs the previous one. The textbook theory says this is a super strong sign that the market's about to turn around and shoot upwards. But hey, textbook theory is one thing. We are here for the cold, hard data. A recent research report did a massive deep dive on literally thousands of these patterns across a bunch of different markets to see if this classic clue actually holds up when you really scrutinize it. So let's follow the evidence. Now, to investigate this thing properly, the researchers knew they couldn't just look at the shape alone. That's way too simple. They had to get a lot more specific. So they actually deconstructed the pattern into a whole family of different clues, mostly based on what the trading volume was doing right when the signal appeared. To do this, they built this really clever toolkit they call the Stat7 family of clues. The best way to think about them is like a bunch of different forensic tests. So 7A is the simplest. It just checks for a volume increase. Then 7B gets stricter, looking at volume over more candles. 7C adds in the price range, and so on. Each one is a more precise, more pointed question to ask the data. So just to see how this works, check out the difference between clue 7A and 7B. 7A is a simple yes or no. Was the volume on that second big day higher than the first? Easy. But 7B adds another layer of questioning. It's looking for a trend of rising volume. See? This approach lets you do a much more detailed investigation than just asking, hey, did the pattern happen? Okay, so with our set of forensic tests all defined, the investigation could finally begin. The first step was to just look for some initial fingerprints in the raw data, see if any of these clues had an immediate, really obvious effect. And boom, right out of the gate, they found something really surprising. When looking at the gold market, our simplest clue, 7A, created this massive split. When the pattern showed up on lower volume, the data screamed a strong buy-only signal. But, and this is wild, when it happened on higher volume, the data actually leaned toward a sell. This is the exact opposite of what many traders would expect. So there you have it, a clear result. Case closed, right? Lower volume is bullish, higher volume is bearish. Well, hold on. Not so fast. The detectives decided to check another crime scene. And this is where the plot really thickens. When they ran the exact same test, but this time on the euro, the results were completely different. It didn't matter one bit if the volume was lower or higher. In both cases, the pattern was followed by a move down. That nice, clear rule we found on gold, completely useless here. And this brings us to a really crucial point, which the report puts perfectly. Across contexts, the same volume logic does not generalize cleanly. In other words, and this is huge, a clue that works like magic in one market can be absolutely meaningless in another. Context is everything. Just looking at historical averages is not enough. To truly validate a clue, you have to put it through the ultimate stress test, a process designed to mimic the brutal, unforgiving reality of live trading. They call it a walk-forward analysis, but I like to think of it as the gauntlet. So here's how the gauntlet works. First, the computer analyzes a chunk of past data to find a rule that might be profitable. Then, and this is the most important part, it tests that rule blind on the next chunk of data that it has never, ever seen before. Finally, it just slides that whole window forward in time and does it all over again, hundreds and hundreds of times. It's a relentless, brutal test of adaptability. So the big question is, how did our clues from the gold market fare when they had to face this gauntlet? Did that promising initial evidence actually hold up when the pressure was really on? Well, let's start with clue 7C, the one that combined volume and price range. It looked pretty good in the initial stats, right? But in the gauntlet, it was a complete and utter failure. As you can see, the key performance metrics, like the average win rate, were consistently negative. This means a strategy based on this clue would have just consistently lost money over time. It completely cracked under the pressure. But now, look at our simplest clue, 7A.
It didn't just survive the gauntlet, it thrived. The performance metrics here, like the average return and the recovery factor, they're consistently positive. It proved to be tough, robust, and adaptable, finding an edge even as the market conditions were changing all around it. In this case, simplicity was its greatest strength. So, after putting all of the clues through this incredibly intense process, what was the final verdict? What did this whole investigation actually uncover about our pattern? Okay, here are the key verdicts right from the report. First, 7A was the clear winner, the sole survivor on gold, the most reliable clue to come out of that whole gauntlet. Second, the researchers found a real flaw in a more complex clue, 7D, but then they engineered a super clever fix called 7E. And of course, the big picture takeaway, context is absolutely everything. Now, this is a fantastic example of the scientific process just doing its thing. The researchers noticed that clue 7D was, well, it was messy. It was lumping signals where all the conditions were bad in with signals where only some were good and some were bad. So they built 7E, which very cleanly separates the all good signals from the all bad and the mixed ones. It's all about refining your tools as you go.
And did all that hard work, that refinement, actually pay off? Oh yeah, absolutely. When they put the new and improved Clue 7E through another tough gauntlet, it produced a strong positive performance of over 5, as you can see here. This just goes to show you that the process isn't just about finding clues, it's about constantly testing, questioning, and improving them. So what's the ultimate takeaway from this whole investigation? It's that finding a real, durable edge in the markets isn't about memorizing patterns from a book. It's all about the process, a deep, skeptical, and totally data-driven approach to validation. This investigation managed to validate one specific clue in one specific market. And it really just leaves you wondering, what other classic patterns might actually hold up under this kind of intense pressure? And maybe more importantly, what entirely new patterns are still hiding out there in the data, just waiting for their own detective story to be told?